Good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, May the 20th, 2025. Let's have a quick review and see what happened overnight. Not a huge amount of action. We did have what we did have though was a 20-year bond auction in Japan. I just want to pull up here. It's not something we've been looking at a lot, but the 30-year bond yield here, or the yield on the 30-year JGB, so the Japanese government bond. And as you can see, that's been ripping higher. And last night we had a big candle. And basically, this is the highest level this yield's been at since it was first issued, actually, a couple of decades ago. So you can see here that's ramping higher. And this is just quite interesting also in the terms of what I was saying the other day, just about how sort of a deficit spending is getting higher. Term premiums around the world seem to be getting higher. So as term premiums and real yields are going up in the US, this is starting to filter out a little bit into other developed markets. And you can see here that the Japanese 30-year is now paying over 3%. I was just looking just now this morning. If you actually, let's say, for example, a Japanese a pension fund, and you want to hedge your US dollar exposure on US treasuries, you now have to, it's now at the interesting point where it's actually getting interesting to just to stay at home and buy your own government bonds. So you're getting 3% here unhedged. Whereas if you have to hedge, you have to pay, the couple of percent on the US sort of a dollar income. So that's kind of quite interesting here. But what we did get, you have to say, why did this spike up? Is that the auction actually didn't go that well last night, apparently in the 20-year, and that put some upward pressure there on the yield. So it's interesting to look at that in the context of the Japanese yen as well. So you can see here that the yen, this is USD yen, so this is the yen strengthening quite a lot over the last 4 days, and that was also on some comments by the finance minister, Mr. Kato, who basically was saying that he would be speaking to Treasury Secretary Besant, and they would be discussing, amongst other things, FX. And now he said that, what were his exact words? He said that we are going to keep the same kind of parameters, but the market took that a little bit to think, that maybe there's some sort of deal in the offing that maybe the Americans will say to the Japanese, hey, if you want to sort of strengthen the yen a little bit, that'll make the US dollar a bit more competitive in terms of exports. So that was kind of interesting there. And keep in mind that we do have in Canada, starting today, tomorrow, and on Thursday, there's the G7 meeting of finance ministers and also the central bankers. So everyone's going to be talking there. There's going to be a lot of sort of bilateral talks in the corridors. So I think it's important to keep our eyes or our ears open for any comments about FX. FX as being FX levels as being part of sort of tariff agreements. And I just saw a note, I think it was from ING, essentially saying that the communique for the G7 meetings, so the G7 finance minister meetings, going back a couple of decades, has essentially always said that FX levels should be left to market forces. FX levels should be a function of market forces. No intervention, no manipulation in terms of trade or to get a competitive advantage. But what is interesting is that, at least according to some analysts at ING, there's a possibility that at the end of the this G7 meeting in Canada, which is on Thursday afternoon, the communique may want to tweak that language, and that would be probably a relatively low probability. But if that happens, that would be quite a significant move, and that would definitely get the FX market's attention if they tweak the language of the communique on Thursday to say something that FX was not purely a function of market forces, because that would indicate that the US is putting pressure on certain countries behind the scenes and essentially saying, hey, you guys need to sort of strengthen your local currency to make the US dollar a little sort of cheaper, which would help the US in terms of their exports. And we should note that things like the Thai baht and the Taiwanese dollar, for example, just to name a couple, and the Korean won have actually sort of strengthened against the US dollar over the last couple of months. So maybe this is happening anyway. So it's interesting just to keep in mind what's happening in Japan here. And just technically, while we've got the USD yen here, This is getting to quite a critical point here because if we look at just the fib retracement here, we can see that if the US dollar bulls are to come here, they're now getting into the fib on this sort of latest impulse up for the US dollar. We're now down at about the 50% zone. So that's sort of held just overnight here. But if it gets back down below, let's say 143 here, you've got to say that maybe the yen wants to go for a double bottom retest here, or the US dollar wants to go for a double bottom retest here and head back down to 140. But we'll see. So keep an eye out on this G7 meeting, which is, as I say, starting in Canada today. Because Percent will be there, all the central bankers will be there, and all the finance ministers. So there's going to be a lot of conversations one way and another. Okay, in terms of other stuff which happened overnight, let's just look at the Australian dollar. I'll just bring it up while we're here. So you've got the Aussie dollar, which actually sort of weakened a little bit against the US dollar, and there was no surprises. I just want to show you some comments here. The central bank in Australia that actually weakened. They cut by 25 basis points. But what's interesting is that one of the reasons, and that was expected, but one of the reasons the Aussie dollar weakened a little bit is because, as you can see here, just some notes here from the RBA, there was a discussion between a 50 basis point cut or a 25 basis point cut. That was what Governor Bullock said. And she said that they did, in fact, discuss potentially cutting 50 basis points. So that's obviously a little bit more dovish than the market was expecting. As I think I mentioned yesterday, the market was expecting a 25 basis point cut, but relatively sort of neutral, even slightly hawkish. But the fact that they did discuss a 50 basis point cut got the market's attention. The other thing as well is that they said that the inflation continues to moderate, and basically saying that there were sort of downside risks and that there was a lot of uncertainty. Escalation to global trade conflict is a key downside risk, and global growth outlook was downgraded. And it added that there's more uncertainty. So the point is they were fairly cautious. They said that inflation might rise a little bit on the tariffs, sort of a one-off, but basically they expect that to moderate over time. They discussed a 50 basis point. So all that to say that the Aussie dollar is probably under a bit of pressure and is still, very much dependent on what happens with the tariff situation there. Okay, so just looking at some other markets. Actually, just while I've got some charts up here, I just want to show you guys something which I pulled out this morning. This is some estimates here by the Bank of America and the Committee for the Responsible Federal Budget. So let's just first of all keep in mind that this could be a little bit more on the fiscally hawkish side of things, but quite interesting just to look at what's going on, because we know that the reconciliation bill, which is going through the motions at the moment, but the point is here that the extra costs. According to these approximate estimates, are about $5 trillion over the next 10 years. So there's new tax cuts, there's more money for defense, there's extending the tax cuts for individuals costing 3.7 trillion, also some extra tax cuts for sort of corporations and whatnot. So overall, they're saying that this package will cost about 5 trillion. And then you say, well, okay, what about the DOGE and the Department of Government Efficiency? But basically they're saying here that, there could be some savings here, some tariff income for sure might be coming in of, 0.9 trillion. There could be some other cuts and whatnot, but only about 2.3 trillion of sort of positive news, so to speak, or cuts. So net over the next 10 years, at least according to the Bank of America and this sort of think tank, we're looking at a deficit increase. So that means more bond issuance on the long end, and this is all in the context of the 30-year bond yields going up above 5% over the last couple of days. And this idea that, potentially the bond vigilantes, a Liz Truss kind of moment where it's up to the bond market to essentially say to the administration or any government administration, enough, you've got to cut the spending, and you cannot just have sort of not fully funded tax cuts, which is essentially what Trump is after. So just keep in mind, this is one of the reasons why a few of the more fiscally conservative Republicans actually rejected the first version of this last week. And we also, of course, had the Moody's downgrade. So this is a little bit just sort of what's percolating behind the scenes. And again, as we say, we saw that the yields in the Japanese 30-year they went higher. And so it's going to be interesting because also in the US here on Thursday, I believe it is, or tomorrow, I should double check that. There's the 20-year bond auction, so an auction for the 20-year, and that's traditionally been the least sort of popular of the long tenors. So it's going to be interesting just in the context of the Moody's downgrade on this discussions about the reconciliation bill, just to see how that auction goes. And if there's any sort of evidence of a lack of interest, especially foreign interest in that US 20-year bond, that could cause some ructions in the market. We could get a spike in the yields there. Just in terms of other stuff going on, let's just keep in mind the bulk of earnings season is over. We do have still some quite interesting things, especially for the consumer. We have Lowe's, which is, the home builders, not the home builders, the home sort of renovation kind of company, and also Target, which is a big sort of retail, big box kind of store. So we have those tomorrow. That's going to be interesting to keep an eye on those. Just thought I'd just sort of mention that. Just while I've got all these charts up here, just in terms of the trend chart for FX. This actually is going back to yesterday, but you can see that the trends have all flattened down. So we're now in a period of consolidation. You can see here on the right-hand side that gold has come off. It's sort of ramping higher. And as you can see, those trends are now sort of much more neutral. We can see that the US dollar, had been sold. It's still on a negative trend, but the trend is sort of softening a little bit, whereas the euro strength is softening a little bit as well. So as you can see, overall, in general, fairly low levels of trends. Just while the US dollar has been softening, we've seen that, the pound has had a good little run and is actually sort of strengthening a little bit. But overall, not huge amounts of sort of trending movements, strong trends in the FX space. So in terms of some other stuff happening today, we do have in Canada, we have CPI. And let's just have a look at the interest rate probabilities here. So you can see here that the next meeting in the beginning of June, so a few weeks away, there's about a 2/3 chance of a cut. So the market's pricing in 17 basis points here out of a possible 25%. So it's going to be interesting today just to see what's happening with the CPI. We know that the Canadian economy is relatively soft and has been softening. And of course, the Canadian economy has been under a lot of pressure with the tariffs, especially the car building section down on the province of Ontario. And we know that the new prime minister who won, what is it, about a month ago or so, Carney is anxious to kind of, build up the economy and deal with the Americans. So this, just in terms of the central bank here, the Bank of Canada, what is expected today is actually an attenuation in inflation. We're expecting the year-over-year number to go down 1.6. So pretty significant drop here. Also, non-seasonally adjusted month-over-month to go down to -0.2. So as you can see, quite big drops. But the numbers which the Bank of Canada is most focused on historically is these the CPI core trim, which is expected to remain flat, as is the median year-over-year. So interesting to see some of the components, but let's just have a look at these sort of headline year-over-year numbers here, just to see whether now if that sort of softens, for sure this the possibility of the Bank of Canada hiking in June at the next meeting could go up from 68% to, let's say 70-75%, something like that, could make that a lot more certain. In terms of the interest rates in the US, not a huge amount of change. It looks like the market is settling by the end of the year with about 2 cuts. Yesterday we did get a couple of speakers. That was quite interesting. We had Bostich, who is quite a bit of a hawk, and he was fairly explicit, saying that he personally was favoring 1 cut this year. He said that he was basically a little more. Well, he didn't say he was more hawkish than the market, but basically said that he needed more information, wanted to know more about the effects of tariffs on the economy, and his personal preference for only 1 cut. So definitely more hawkish than the market pricing. And then we got Williams, who of course is the head of the Fed, John Williams, and he made some interesting comments. And he essentially started saying that he didn't think he would need to see more information excuse me, in June and July to really understanding better what's happening with the economy. So both of those Fed members yesterday really sort of saying, hey, we need another 2 or 3 months of data. But specifically, Williams was saying that he didn't really see the possibility of being able to make a decision at least until June and July's data had been registered. So that sort of signifies that possibly he's not thinking of rate cuts anytime anyway before, let's say, like the September meeting here. Now September's fully priced in for a cut, or almost, for 92% pricing here. So just kind of interesting. The Fed definitely seems to be saying, hey, we need another 2 or 3 months. So it looks as though the market, I mean, it's true that the market for the June cut is only pricing in 2 basis points, so that's enough. That's nothing. But what's going to be interesting is this July meeting where the market is still pricing in, a 33% chance of a cut here, so about 8 or 9 basis points. So the more the Fed pushes back on that could go down to almost zero as well over the next, well, I guess month or two. On the other hand, of course, maybe the data will start to come in weaker, and of course that's going to upset all of those comments. So quite interesting there. Just finally, guys, let's just look at a couple of charts to see what's going on. Where are we? Yeah, I think that's it there. So as we see just here on the dailies, obviously the VIX down yesterday. So the VIX here, it's pretty stable here at, 18, 19. We have the May contract rolling off tomorrow. So we go into the June contract as the front contract for the VIX. So yeah, that was giving a bit of a headwind, and it's interesting here that the news on the Moody's downgrade Sunday night, we had a sort of a pop lower, a gap lower, but the market bought that up pretty aggressively, as you can see here yesterday, and we're almost up towards 6,000 again. One thing which is interesting, though, I was looking this morning, is that the up until midday yesterday, the amount of retail buying of equities or retail involvement was 31%. Let me just check my numbers. 36%. 36%. That is the highest ever. The highest ever. So as a percentage of the total buying of stocks, up until lunchtime yesterday, 36% was retail, so not institutional. And that is the highest percentage of retail participation. So all that to say, the conclusion here is that a lot of this push upwards seems to have been a buy the dip situation of retail. So I don't know what the conclusion to that is. Does that mean that retail investors are kind of the smart money in this point, and are they sort of buying towards the top because there's less, less historical percentage of institutional involvement there? So that's an interesting one to keep an eye out here, because institutions seem to be a little more wary of buying up here rather than retail participation. But that was a massive retail buy the dip participation yesterday. Anyway, it is what it is, as they say. And so stocks just up here, it's pausing here because, as you can see, we're well above, all the moving averages. It does seem to me technically there is a little bit of resistance here. This level here is important, 6,025 on the ES front contract. If we can breach that, I think you've got to say that, technically the market likes to test a limit. So there's no reason why I can't get up to 6150 or so. Just grind its way up there, depending on potentially what happens at the G7 finance ministers meeting, if there's any sort of announcements there or anything from Trump, etc. But at the moment, there's not really much data this week. As I say, the only data we really have is the Canadian CPI coming up this morning. There's not really any US data of tier one. So it could be that the market continues to grind up, especially with this VIX, in the 18, 19 kind of handle, relatively low levels there. Just having a look yesterday's action as well, we did see the Mag 7s have a pretty positive day. They're also getting up to pretty key level as well. You can see here that the pre-market are up to 52.34, but basically you can see that this market, this level here on the Mags ETF is, interesting sort of level. And just in terms of equal weight here, the RSP actually did quite well. So the breadth is quite good. So you've got to say at this point, fairly solid in the US equities. If we go over to Germany, very solid as well, making new highs up there. So, global equity is doing quite well. You can't deny that. Just in terms of the bonds, just want to draw your attention to the ZB, the long bond. It bounced off these lows again. Actually, it's easy to see that if we look at the 30-year, it hit the 5% mark. You can see here actually went higher than last time. So last time it got to the 5% and came in with quite a lot of buying. Yesterday it went up to about 504, and there was quite a lot of buying as well. So definitely that 5%. There's quite a lot of real money interest there. So it's going to be difficult, I think, in the short term for the nominal 5% to be breached in the 30-year. That's an interesting one to keep an eye out for. Apart from that, I'm not going to go around all the charts because there really hasn't been too much action. Fairly stable and quiet markets at the moment. So let's keep in touch. Hope that was useful and have a great day. Thank you, guys.